So, welcome. Good morning, everyone that has joined this session this morning. And we welcome you to the very first edition of Tax Simplified. We are so excited to have you join us today. We truly appreciate you taking your time to be here, especially on an early Saturday morning. We know your time is valuable, and we promise you that this session will be worth it. So it won't be a waste of your time. We would actually enjoy every minute and every second that you spend with us today. Tax Simplified is a live and interactive section, and we have designed this to help you understand tax matters in simple, practical, and engaging way. So every Saturday, we'll be bringing together industry experts, seasoned professionals, and what they will come to do here is to share insights, share perspectives, and share with us real-world experiences on current tax issues and best practices. Just before we proceed, I would just like to share some quick tips to us that would help us keep this session engaging and interacting. So please keep your comments very simple, very respectful, and ensure that it's relevant to the discussion that we'll be having today. You can also drop your questions in the comment section at any time. Feel free, please drop your questions during the session at any time, and then we will review the questions and then attend to as many questions as possible during the Q&A segment. So we'll have a Q&A section. It's actually a Q&A session, so we'll be taking as many comments as possible. All right. So, but before we start taking your questions, we would like to first discuss some of the topical issues, right, arising from the new tax reforms. And I'll be discussing the impacts of these issues, the impact on individuals and on businesses. So please, before you go ahead, please, if you have not subscribed, if you have to subscribe, please subscribe to the channel and then turn on your notifications. So the reason you are doing this is because it will help you. It will help you know not so you won't miss any session again in the future. Any episode of this tax simplified, you won't miss it in the future. So if you subscribe and turn on notifications, YouTube will send you a notification and let you know that the session is live so that you can join and you won't miss any bit of the session. Also, help us share the link of this live session with your colleagues. Share the link with your colleagues. Share it with your family members. Share it with your friends. Share it with your neighbors, and even your enemies. Share it with them so that they can also benefit from what we'll be discussing today. Also, make sure to click the like button. Please click the like button so that you too can push this live to other people who needs to be in this session as well. Once again, I want to welcome you to Tax Simplified, the very first episode, the maiden episode of Tax Simplified, and thank you for staying with us. All right. So, without much ado, I think we'll just go into the conversation of today. Of course, we all know why we are here. We are aware that the Nigerian tax landscape is currently undergoing a landmark reform, and the reform is actually it has a lot of impacts, right, on our businesses, on our finances, and even our personal, individual finances. The impact is far-reaching actually, and these reforms, right, they represent a major milestone in our country's effort to modernize and streamline the tax system. The four acts, four acts were recently signed into law by the president, by President Tinubu, Bola Ahmed Tinubu, and this act is the foundation for the reforms that we are currently experiencing in Nigeria, right? So the acts are the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Establishment Act, and the Joint Revenue Board Establishment Act. All right, don't worry, I would explain each of them to you and the aim and objectives of these different acts. All right, so that it won't be too technical for you to understand. All right, so the Nigerian Tax Act actually consolidates several existing tax laws into one. So we used to have different tax laws before. We have the Companies Income Tax Act, the Personal Income Tax Act, the Value Added Tax Act, the Capital Gains Tax Act, and many other tax acts. So, but what this Nigerian Tax Act has done is to actually pull all those acts together and make them and put them into one singular comprehensive document. And it's actually very comprehensive and it's designed to actually simplify compliance, improve the overall clarity and consistency of the Nigerian tax legislation. All right. So that's the Nigerian Tax Act. Then the second one is the Nigerian Tax Administration Act. This act actually provides a framework for the administration and enforcement of tax laws, right? So it provides a framework upon which the provisions of the tax law in the Nigerian Tax Act can be administered and enforced. It outlines the procedures for assessment, for collection, for dispute resolution, and for taxpayers' rights, and it ensures fair and transparent system for both taxpayers and the tax administrators. So that is what the Nigerian Tax Act is actually aimed to achieve. The third act that was introduced under the new Nigerian tax reform is the Nigerian Revenue Service Establishment Act. This act actually replaces the former Federal Inland Revenue Service Establishment Act, and it kind of replaces the FIRS with a new structured and modernized Nigerian Revenue Service that will take effect from January next year, 1st January 2026. FIRS will no longer be FIRS, they will now become Nigerian Revenue Service. And this new agency starts with enhancing efficiency, leveraging technology, and strengthening the integrity of tax administration in Nigeria. The last one, which is also very important, right, is the Joint Revenue Board Establishment Act. This act actually established a coordinated framework among federal, state, and local tax revenue authorities. So it provides a framework where all the tax authorities at the federal level, at the state level, and the local government level can work together, can collaborate to eliminate duplication of tax and to create a more unified approach to tax administration across all levels of government. So this also very important because as we speak, the issues with at the federal level and at the state level to an extent has been resolved. But when you come down to the local level, local government level, we see that there is still a lot of adoration going on in that space. And of course, that's already been worked on by the tax reform committee, and they are coming up with a framework to address that sector, and that will be also be issued very soon. And with that, we would have that was also aiming at unifying the taxes at that level. Currently, you have different types of levies, taxes being released by local government. Today they come with signage, tomorrow they come with TV permit, the next time is business premises, the next time it is gaseous waste, you see all sorts of levies coming from everywhere. So, but with the new, but what is being done currently at that level, all of that will be eliminated going forward. So, all of these acts, these four acts that I've discussed, they are actually going to take effect from 1st January 2026. 1st January 26 actually looks far. It's like, although it's not far, it's a month away, but it's good that we start talking about it. And of course, if we're talking about this conversation has to be ongoing, right? We cannot stop at any point. Even after the implementation date, we will continue to talk and discuss issues that arise as we implement the new law. And we always engage and find out ways in which we can help um, minimize or mitigate adverse impact of the tax laws on taxpayers. All right, so it is important that um, taxpayers, business owners, and professionals that we begin to familiarize ourselves with these changes and getting to know, familiarizing yourself cannot be too much. You cannot overlearn. You continue to learn and learn and learn. At every opportunity you find, it's good that you take advantage of the opportunity and learn as much as you can. Even things you already know, it's good that you also refresh what you know and get perspectives from other people, which is what we'll be doing here because we'll be bringing different professionals, different experts from different fields who will come and share their perspectives on how the tax law is impacting them and how the implementation has panned out for them in their different companies and industries. And this will also help us to assess implications across board and help us make necessary adjustments ahead of time. So we are starting this conversation now. This is our first episode, and we can assure you that as stakeholders, if you continue to stay with us and you continue to join this session, you will be well informed and equipped to transition smoothly. And when this law takes effect, you will be in a good place to implement effectively and efficiently in your respective space. So that is why we've conceived this idea of Tax Simplified. Our goal is to help you unpack the reforms, unpack the tax laws, unpack the different provisions of the tax law, clarify the implications, and help you navigate the evolving tax environment with confidence. So now, having said all of this, I would like to go straight into the conversation of today without wasting much time. All right. So yeah. So basically, the first thing I'll be talking about, the first controversial. Because before I go ahead, please, Moshood Farid, thank you for joining. Yeah, thank you for joining. Please like the session and also share with your friends, share with your colleagues, share with even your enemies. Call everybody that needs to be here. Let them come on board and join us today. Yeah, you're welcome, Moshood. You're welcome. So please call. You can reach out to as much as people that you know. Let them join us, and for this session, so that it will be more interactive. All right. Yeah. Welcome everyone. I can't see everybody's name actually, so I will just do a blanket welcome for everyone. All right. Yeah. Welcome to the session today. All right. So the first issue I'll be touching on is issues around um, the issues around TIN, NIN, and the registration number. So please feel free to drop your questions in the comments. Drop questions. Drop your comments, observations, contributions. Feel free to drop in the comment box. And of course, I would be if you want to speak, let me know. I can bring you up to speak. I can actually bring you up so that you also speak in this session if you intend to speak. All right. So okay. Okay. Let me see if I can share my screen. I think it's possible. Um, Let me share my screen from here so that we can uh, be on the same page. All right. So let me know if you can see my screen now. Uh, okay. If you can see my screen now, let me know. Yeah. Okay. So let me know if you can see my screen now so that we can then and you can still hear me loud and clear. So let me know. Just type in the comments. Let me know. Let me know. Tell me a yes if you can see my screen. Tell me a yes, please, so I can proceed. All right. If you can see my screen, tell me a yes. Okay. I'm waiting. I'm waiting. I'm waiting. Can you see? Okay, you can see my screen. Okay, great, great, great. Thank you. All right. So the first thing I'll be talking about is the issues arising um, are issues arising on TIN, NIN, and registration number. So, of course, we all know it's not new. We all know that banks, insurance companies, stockbroking firms, and other financial institutions they are now required to submit quarterly returns to the appropriate tax authorities. So that is the first trigger for everybody. Once you have a business account, just know that your account will be reported to the tax authority. That one is sacrosanct. So and once you and of course it's not all business accounts. It's accounts that have transactions above 25 million naira for individuals. That's for sole proprietors, and for companies with account balance above 100 million for companies. So all those accounts will be reported to the tax authority. All right. So this is the genesis of the whole issues, and then because and then so this then means that if you are a business owner or a company and your records are submitted to the tax authorities, and they marry and they compare those records with the returns you have filed with them, and they are not jiving, it becomes an issue, right? Because the tax authority will then want to know why would want you to come and explain to them why your transactions do not agree or do not correlate with the returns the banks have submitted. So what you then need to be able to do, of course, we all know that all credit entry to the bank account would not be turnover. Some may be loan. It may also be monies that customers have paid to you to help them um, uh, uh, carry out a contract. For instance, if you're into a contract of supply, then you'll be paid the contract sum for you to execute the contract, and that clearly is not your turnover, right? So if you also earn commissions, the total amount you receive is not your turnover; it's your commission that's your turnover at the end of the day. So clearly, there's going to be a gap which you then need to be able to explain and demonstrate to the tax authorities. So this is where the issues lies, and this is where you need a consultant or an in-house accountant to help you do proper reconciliation with the tax authorities. And then of course, when banks are doing this, before they even do this at all, they are now mandated to request TIN from every taxable person. So every taxable person, they are now mandated to request tax identification number from them. So what this means is that if you are taxable person, take note of that. So it means if you are a private person, what you have with your bank is your salary account. The bank will not report your own transaction because what you have, what you are a taxable person, and what you have is a salary account with them. So, but once you are a business name, you have registered a business name because you will submit your, if you're opening a business account, you will submit your CAC registration documents. So, if you're a business name or a limited liability company and it's a business account, the tax authorities will report this to the tax authority. The bank will report it to the tax authorities. And where your before you do this, they will request for your TIN, meaning you must have registered with the tax authorities. So really, there's no hiding place anymore, right? Even though this is not a new requirement, right? But it was not in the tax law. It was not embedded in the tax law before. So now what they have done is to actually embed this requirement in the tax law. So now it's now an offense or a crime if banks do not get TIN for every their business account. And it's now an offense if the banks do not submit details of transactions of businesses and companies above this amount, 25 million for individuals, 100 million for companies. So if they don't submit those details to the tax authorities on a quarterly basis, it's now an offense. So so this is it is very important that we take note of that and we ensure that we maintain our books and keep adequate records to be able to explain and reconcile our position with the tax authorities. So there's this common question that comes to everybody's mind. So does it mean that if the bank submits my transaction details to the tax authority, are they going to levy me tax? Are they going to subject me to tax based on the amount that the banks have reported to them? The simple answer is no. The FIRS, the tax authority, whether state or federal, they cannot subject to tax based on the amount in your bank account, the transactions flowing through your bank account. They cannot subject it to tax based on that basis. They will not do that. What they will do is to call you for inquiry. They will call you for scrutiny or an audit or a debt review. They can write you a letter to say, okay, we've seen this much transaction flow through your bank account. Can you show us evidence of tax compliance? That is what they will show you, they will ask you to do. So, so you have the opportunity to actually um, go to them. Either you go directly or you get a consultant, a tax consultant to represent you. And then the consultants will then go there to show them how that amount that they found is not your turnover and is not your profit. So you would then need to explain to them what constitutes your income, your expense, your profit, and then what makes your tax, what is then your tax payable, right? So they will do this for income tax purposes. They will do it for value-added tax purposes. So it is your responsibility based on the tax law. You have the right to actually demonstrate to the tax authority that that amount should not be subject to tax, and that is not the basis for your own taxation. So that the law provides and guarantees you that right. So the tax authority can never tax you based on the amount in your bank balance. But if they write you a letter and you refuse to show up, you ignore the letter, you did not show up, you did not provide any explanation, you did not request for additional time, because you can actually request for additional time if you are not ready to respond. If you don't have the adequate information to respond yet, you can actually ask them to give you a 2 weeks extension, a month extension, 2 months extension. Just be reasonable, right? The time that is enough for you to prepare the information that you need to give to them, right? To explain yourself, you can ask for that extension. So, but if you fail to respond, ask for extension, you didn't do anything at all, the tax authority will write to you again. And they can now, in second instance, they can now issue you a BOJ, So BOJ is best of judgment assessment. They can now issue a best of judgment assessment, which then means that they can now deem the entire amount to be taxable. They can deem it to be your turnover or your profit because you refused to come forward to explain yourself. So it may just mean in law silence means consent. So if you have kept quiet, it then means you are agreeing that whatever the FIRS comes up with or the Lagos State Internal Revenue or FCIRS, whatever situation it applies for you, it then means you are agreeing that they can come up with any assessment that they deem fit that should be your tax payable. So I'm taking my time to explain this. All right. So if you have questions, please drop in the comments. I will take your questions. All right. So another thing that is very important for us to note is that TINs will be linked with me, and that's for individuals. So for if you're a business name, you run your business account with the tax authority, they are going to link your TIN to your national identification number, right? So even if you don't have, even if, so I'm going to link all this together. For businesses, they will link it to the registration number so that at whatever point in time, if your TIN is entered into the system, your details will come up, your tax compliance details will come up. If your registration number is entered, your tax compliance details will come up. So really, it just shows that the whole system is being synchronized and there's no hiding place anymore. So this is telling me is that if you're not tax compliant, you may not be able to do anything on your NIN or your business registration number. So it's going to look like a validation, like how will I put it now? For instance, if you want to file your annual returns to CAC, if you have outstanding tax returns, you're not able to file your annual returns. And if you have annual outstanding annual returns, you're not able to file your CIT returns. You understand, right? So all of these things will be linked together. And even your bank account, you're not able to do some things if you are not, if your profile is not showing compliance. So what that is the direction we are looking that the tax authorities may be looking at in the future. All right. So so please you can start dropping your questions. We are uh, deep into the session now. This 22 minutes in. So by 10:45 we would actually start taking questions so that we have like 15 minutes to answer the questions. All right. So I'll then move to another topical issue, right, that has been all over the place. So people are confused whether they should maintain, people, especially people who have set up as business name, they are confused whether they should maintain status quo as business name or they should upgrade to limited liability company. Of course, there has been conversations out there that running your business as limited liability company is the most tax efficient option for any business owner. That conversation is out there. Yes, so that has a lot of merits, right? So, but then again, it is dangerous to just apply a paintbrush on all kind of situations. So it's good that we also consider specific considerations for different categories of businesses, right? So for business names, most business names are small companies. They are mostly micro, small, and medium scale enterprises, people that run business names, except in limited situations where law or a statutory requirements requires that a particular line of business be set up as a business name. For instance, accounting firms, law firms, estate surveyors, all of these people. Okay, I'm not sure about estate surveyors, but I'm sure about lawyers and accountants. These businesses, based on law, must be kept as business names. So even the big fours, the big 10 firms, the big law firms in Nigeria, they are business names. They can never convert to limited liability companies because of their own specific requirements, specific regulatory and legal requirements. So for them, they are not even part of the discussion. They are not bothered about this. So, but for other micro, small, and medium scale enterprises who are operating as business names, what you need to consider first is you need to know that grouping, that grouping is very broad. So you have people running businesses that make turnover of 12 million, 25 million, then you have 50 million, you have 100 million, you have 200 million. You even have SMEs doing 1 billion naira. That's the truth. You have SMEs doing 1 billion naira. So, so you need to stratify and then consider. Don't just apply a blanket position on all these businesses. So you have a welder, for instance, who will take home on a monthly basis maybe 100,000 in a month, or you have a shop owner who sells provision. What is the margin on provisions? She struggles to make 100,000 in a month, right, as our own profit. So when you're talking to this type of people, or when these people are watching your videos, you need to be able to you need to tell them separately that, okay, for you as a micro business, you are still covered adequately if you continue to operate as a business name, right? So you need not upgrade to limited liability company, right? So because if you are running your business name and you're earning just 100,000 in a month, you are still exempted from tax. You are within the minimum wage category, and you're exempted from tax. And the truth is that these people, they actually make up over 90% of the SME group. So if we know that, then we would be careful in advising just everybody to upgrade from business name to limited liability company. All right. So these people are fine running their business name, and they would need to take up additional costs that they may not be able to pay. And that those costs can actually kill them. It can kill their business and run them out of business. So it's important that these people know specifically that this these requirements do not necessarily apply to them, and they can continue to operate as a business name. So, but of course, if your turnover is already shooting above 100 million, or even 50 million in some instances, right? Depending on what. So currently, we don't have a clear position on what the definition of small business is. So the argument that is companies with 50 million turnover, the argument is companies with 100 million turnover. So of course, the Gazetted Act says 50 million for small companies for CIT purposes. So, but of course, we are also getting information from certain quarters that it's actually 100, and and we've seen a new document released by the Reform Committee saying that small businesses is companies with turnover of 100 million. So we can safely use 100 million at this point, right? And say that if your business name, right, if you're already doing turnover of 100 million, right, even if your net profit, right, is or your income is below 1.2 million, which is exempted for individuals, then you should actually start considering upgrading, because the matter of time you are going to be in that, you're already in that bracket. It's just a matter of time for you to blow out, and then you have to then need to consider all those other requirements and all those coverings that you get by being a limited liability company. All right. So I think I've explained that enough. Let me just go. So for business name and limited liability company, of course, there are clearly advantages for you to operate as a limited liability company. That is if you have checked and you see that, yes, I cannot continue as a business name, it's no longer beneficial to me. I'm now out of the minimum wage bracket. Then, of course, you can now move, you can now upgrade to a limited liability company. And what that gives you is that it gives you legal protection. It gives you legal protection. When I say legal protection, the company is seen as a different business, as a different legal entity, and you are also separate from the business. So that means that if there is any issue at all and the companies become bankrupt, and there's a need to take over the assets of the business, or take over assets to settle your debt, it is only the asset of the company that will be taken over, the asset that the company owns. So your own personal property, your house, your home that you cherish so much, your car, every other, your investments, your private investments, all of those would not be tampered with. They will not be touched. So the liquidator will only consider the company's asset to settle whatever debt that the company is owing. And if the company is also sued, if there's any reputational damage or any legal or financial consequences, it is the company that bears all of that, not you, because the company is seen as being a separate person, different from you, the owner. So that is the most important protection that upgrading to limited liability company actually provides to business owners, right? So it gives you that legal protection, that legal separation. Your risks, the risks and your risks and the company's risks is then clearly separated. And of course, your liability is limited. I've explained that. So your assets are not taken over if there's any declaration for bankruptcy or if there's any reason to take over the assets of the company. All right. For compliance, of course, when you become a limited liability company, then much more compliance is required from you, right? So you need to then start filing annual returns, right? That's annual returns to the company, the FIRS. You would also file your individual tax returns. Being an employee of the limited liability company or a shareholder or a director, whatever it is, you need to file your own personal tax returns. You need to prepare audited accounts, prepare annual audited accounts, and put an auditor to help you with audit. You also need to set up some governance structure within your company. You need to have board of directors. You need to have an internal audit function set up. You need to have you need to have an HR department, for instance. You need to set up proper, you have to put up proper structure to run that company. But under the business name arrangement, you may not necessarily do all of that because you are a one-man business, you run your show. In fact, you are able to manage all of these things yourself when you are a business name. All right. So, of course, limited liability company also gives you that professional feel and provides that additional credibility. So, for instance, you are going for a contract bid. If you submit a contract bid to a multinational, for instance, if a business name submits and a limited liability company submits, of course, they would prefer to consider limited liability companies because clearly you can see that there are more people being involved in, in the limited liability company and there is more credibility because it's a limited liability company. It provides that credibility and that professional outlook. And then for taxes, for all your limited liability company and your turnover is still below 100 billion, then you'll be able to pay, you won't pay tax at all. So your tax, will be charged a tax at 100%. You will also be exempted from issuing VAT invoice, right? So you don't need to issue VAT invoice if you are a small company. So, but immediately you cross 100 million, then you need to start paying income tax and then issuing VAT invoice and all of that. So basically, so of course, so the truth is, limited liability company offers you better protection. It provides better credibility. It gives you a more enhanced profile when dealing with investors, dealing with government, dealing with companies, suppliers, and all of that. So, but again, let's put it in context. Let's be sure that check and ensure that yes, you are actually supposed to upgrade. You are no longer a micro business. And of course, if you are no longer a micro business, then you should consider upgrading actually to limited liability company. Yeah. So you should consider upgrading. Yeah. So I'll just do a recap again when the time that you should actually consider upgrading is when you are seeking new investors or expanding operations, then you should actually consider upgrading. When your turnover exceeds 100 million, and when your own net income as an individual running the business exceeds 1.2 million in a year, then you should consider upgrading because clearly you're no longer meeting minimum wage bracket and you'll be subject to income tax. And to some extent, if you and to some extent you can still flex it. You can if you see that if even with incomes of 2.5 million, the tax impact is not so much compared to the cost you incur when you're a limited liability company. That's another way to look at it, right? So for me, I will still consider that as well. So if my net income as an individual is still within the bracket of 2.5 million, 3 million naira, I would rather still stay as a business name because when I look at the cost of tax compliance or paying tax with a 3 million naira gross income in a year, and I compare with the cost cost of converting of upgrading and then the cost of the statutory compliance, I would rather stay. I would rather remain a business thing. So it's better that you sit down and then run your simulations, run your numbers, analyze those numbers, interpret them, so that you understand, get deeper insight before you jump into converting or upgrading. All right. So of course, where there's regulatory requirements to be a limited liability company, then of course you set up as a limited liability company. And then when you separate, when you separate your personal and business risks, that you want to have a separate legal entity for your business, then it's fine to upgrade. This point also applies to people who are setting out to incorporate new companies. So you need to also consider that this new company I'm setting up, am I sure that we are going to exceed the minimum wage net income in my first year? Will I exceed that? Will I actually go grow big like immediately? So if not, you can actually give yourself grace, right? And run your first year, second year, third year, and see things play out first, pan out first before you upgrade to limited liability company. So I think it's better to start small and then grow big. But if clearly you can see signs that starting, immediately you're starting, you are growing big, then of course, go ahead, limited liability company straight, and then run the show, being a limited liability company. All right. So, but if you have already looked at it and you think that no, I'm starting small, I'm going to run small for a long time, then you should actually remain business name. Okay, so I want to quickly address another group of people. So for remote workers, right? So a lot of remote workers have come to me in my inbox to ask me questions around how what they can do to structure their pay. Of course, they have employment contracts from their offshore employer, right? The offshore employer does not have any obligation to file personal income tax returns in Nigeria, right? That's been taken away. So no obligation. They don't have all of that obligation again. So the obligation is now on the individuals, the remote workers here in Nigeria. They now have the personal obligation to submit their own tax returns, do a self-assessment, and do a self-declaration, right? So so the questions has been, advise me, what should I do? Yes, I know I need to file my tax returns, right? But I'm a remote worker. I don't have an employer that will put me in his own. I don't have a Nigerian employer that will put me in his own from H1. Annual returns and file in January. So it means I have to file myself, which you will file on 31st of March every year. So how do I go about it? Of course, you don't want to. I wouldn't advise you to go in as an individual. So it's either you set up a business name or limited liability company. So, but for most remote workers, the business name option is not even on the table because, of course, the incomes for those type of people exceeds is way above the minimum wage. And the truth is that they actually a lot of them get employment with different employers, right? So they can have up to 4 or 5 contracts. Especially people that work on Fiverr, freelance, and all of that, they can get up to 4 or 5 contracts, and they have different income streams. This also applies to YouTubers, social media influencers, all of these are people that earn income from um, not from employment, right? People that earn income from doing things personally that's not under a structured employment contract. So the best thing to do is actually set up a limited liability company, right, under which you can warehouse your income, and then you have your annual audits done. You have a statement of accounts for yourself, where your profits, where your income and expenses are put into consideration, and then you have a net income, a net profit that is subject to company's income tax. So what this does for you is, if all those your income is not up to 100 million in a year, then you are seen as a small company. The company is seen as a small company, and then you do not pay so much tax. So you set up a company, so that company pays you salary, right? So of course the company gets income from all of the payments you get from offshore. You consider all the costs you incur generating that income, and then the net position is what you then subject to company's income tax, right? Which you be, of course, whatever is left, and then you pay yourself salary from that business, right? So the salaries also, so some people, you can actually structure it in a way that your salary, the salary you get from it is not so much above the minimum wage, and then by the time you distribute profit at the end of the year, your dividends is subject to only withholding tax. right? Dividends, because when you distribute profits from a company, what you are doing is you are distributing dividends, you are appropriating dividends, and that dividend is only subject to be total tax at 10%. So that reduces your tax, the tax consequences for you as a small company. All right. So it's 10:40. I want to see if we have any question that we can quickly address. Okay. 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 So somebody dropped something here. The business cost incurred by a business name be deducted from the business income before subject to tax. Yes, correct. So for business names, right? So you have to consider all of the costs that you incur. All right. Okay, this question is from Oluwatobiola Faji. Okay, thank you, Toby. Thank you very much. Yeah. So yeah, that's a good question actually. So yeah, so for business names, you have to actually take out all your business costs before you subject the income to tax, which is why I said that all the inflows into your bank account is not taxable. No tax authority should tax all the inflows into your bank account, right? And I tell you the only instance where they can raise best of judgment assessment. So, but you can still object to that if you do it on time. All right. So, in determining your tax, you need to first consider all your income, then you deduct all the business costs, right? When you incur the business cost, when you consider the business cost, whatever is then subject to tax. So, but this applies when you have not properly structured your business, right? So, when you have not properly structured your business profit can be subject to tax. So, but when you have structured your business in such a way that your business pays you salary, if your business pays you salary, then it's a different conversation entirely, right? So your salary is what will be subject to PAYE, right? And then whatever profits you have in the business, whatever profits you have left in the business, you can decide to reinvest back into the business the following year. That is where you have properly structured your business name. So it's important you also consider this and get professionals who can help you come up with proper structure for your business name. It's very important. So if running as a business name can have two implications for you, right? So you can still be running a business name and be subject to PAYE, right? And you can also be a business owner running a business name and be subject to personal income tax. So it depends on how you have structured your business, right? So it's important we take note of that. So um, I can provide if you need specific explanation on this. You can reach out to me privately, and then I would guide you on what to do to structure your business name properly, so that you are taxed. You are paying tax under personal income tax, under PAYE, and not personal income tax. So there are two different things, right? So the one allows you to plow back your business, your profits into your business, right? The other one subjects your entire profits to tax. So you can reach out to me and then I would provide to you specific guidance on how to go about structuring your business name. Even though the business name is seen as largely informal, there are still ways around managing tax exposure for a business name. All right. Thank you, Toby, for that question. That was a good one. Okay. So let me check. Okay. There's no other question here. All right. Okay. So I think we've discussed this at length. The upgrading from business name to LLC. So if you still have any question on this, feel free to drop in the comments and I will answer them and I'll answer your question. Okay. All right. So another thing I want to talk about is the pioneer status incentive, right? The pioneer status incentive. So the pioneer status incentives has been replaced with what we now call the economic development incentive scheme. All right. So um, as we speak now, the NIPC, that's the Nigerian Investment Promotion Council, has stopped accepting fresh applications for PSI. That's under the old regime. They stopped accepting fresh applications. So they are transitioning into the new scheme, the new EDI, right? And what does this mean for us? It means for companies who are currently under the PSI arrangement, they will continue to enjoy the PSI incentives, right? While for companies that have not applied at all, they cannot benefit from the PSI incentives anymore. All right, so there's a question here. Okay, that means business name owners will have more interaction with LIRS. Thanks. Yes, 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 yes. So business name owners will have more interactions with the LIRS than FIRS. Yes. So if you are a business name owner, you are going to all your tax obligations will be to the LIRS. That's if you are in Lagos State Internal Revenue Service. If you are in Ogun State Internal Revenue Service. Your business is in FCT Internal Revenue Services. So depending on what your business is, then your personal income tax returns will go to wherever your business is actually. So you have more interactions with them and not the FIRS. All right. So for business name owners, it's important to know that. So you don't have no dealings with the FIRS if you're a business name owner. It's only companies registered as limited liability companies that have interactions with the Federal Inland Revenue Service. All right. In fact, for companies, you have interactions with both FIRS and your state tax authority for a company. But if you are running a business name, you only have interactions with the states where you reside. The only the only time that you get to interact with the federal is if you opt to charge VAT, if you register for VAT and you decide to charge VAT. So some businesses will actually want to issue VAT invoices, even though they are exempted. So nothing stops them from registering for VAT and issue VAT invoices. And the reason any business name, the reason any business name will consider actually charging VAT invoices as taking up that additional obligation is because they want to be able to do business with large companies. So let me explain that. In the new tax law, large companies they are not expected to if they take up if they buy make purchases from businesses that do not charge VAT, they cannot expense that expense. I don't know whether you understand that. So if you're a large company and you pay for any service or any product and VAT was not charged on that product or service, then you cannot deduct that expense from your books for tax purposes rather. You cannot deduct that expense. So to a large extent, big companies will want to do business with companies that charge VAT so that they can expense that cost and also claim the input VAT on that cost. So that is why many business names will actually voluntarily register for VAT and then issue VAT invoice. Okay, so in that instance, business name would actually have interaction with the FIRS as well. Okay, all right. I hope that is clear. All right. So yeah. Okay. So thank you, Moshood, for that additional insight. Okay. Thank you. All right. So okay. So please keep your comments coming. I like them so that we can deliberate as much as possible. All right, so back to the pioneer status and the pioneer status and the EDI. So the pioneer status is going, put it long. And now we are looking at EDI. So no more applications under the PSI scheme. So now it is now EDI. And in fact, the NIPC is now accepting fresh applications again. Only ongoing applications are being finalized. And there's actually a timeline to finalize and close out on all ongoing applications. And they are preparing a new guideline on how for the new EDI that will be applied going forward. Okay, so the EDI is largely different from the PSI. As in the difference is so much. As you can see, it's clearly different, and the objective of the EDI is different from the PSI. So the PSI rewards rewards what will I put it now? It gives enormous benefits to investors, right? After they've invested in specific sectors. So, but the EDI is more of an incentive, a performance-based incentive, right? Let me put it that it's more of a performance-based incentive, and it was designed to actually drive investment, capital investment in the economy, and to increase economic development and speed up the rate of economic development. Under the EDI, you can now get a 5 year straight tax holiday. 5 year straight tax holiday. Under the previous scheme, you get a 3 years first and an additional 2 years. All right. So I'm waiting to see if we get more questions. So under the current scheme, you get a 3 years plus another 2 years if you apply for extension. So but under the new scheme, you get a 5 year straight tax holiday, and you can get additional 5 years if you actually reinvest all of the profit you make in that business back into the business. You put all the profit back into the business, then you get 5 years extension. So that means that all your investments, you lock it in for 5 years, and then you get additional 5 years holiday. All right. So the capital requirement is now very steep. So it's high as 500 billion in some sectors, and previously it should be 100 million across all sectors and industry. So, but now we have as high as 500 billion. So this is actually a major concern for many investors, and people have raised serious concerns with the NIPC with regards this. Personally, I've worked with a company that I've worked with a client that finds this very very discouraging. Okay, there's a question here. Sorry, the deduction for a limited liability company before tax due. Okay, I want to understand this. The deduction for limited liability. Okay, yeah. So for limited liability companies, right? You you can, when you prepare your financial statement, you bring in your income, you take out all your expenses, as in valid expenses, so expenses that relate to the business, not personal expenses. So people are telling people that all your personal expenses you can put it in your company once you incorporate a company, and you'll be able to deduct it and get away with it. It's not true. That is a fallacy. It's not true. You cannot deduct personal expenses from your company's books. That is why you are separate from your company. So people, they tell you that you get protection, your company is separate from you, but they still want you to put your expense in that same company that you are separate from. So you can see that it does not make sense. It does not does not make any sense. So in the real sense, you cannot deduct your personal expenses from your company's books, right? So there are certain arrangements you can do, right? If, for instance, you have a proper structure, you have an employment letter with that for your company, on your employment contract, it is there that your benefits, you have a benefit in kind of vacation every year, annual vacation, or 2 times in a year. The company will cover the cost. Then that can be deducted. So, but it will then be considered as a benefit in kind for you, and you will pay your personal income tax on that amount, right? So in that instance, you can deduct it. But it's not that you put all the vacation expense on the company and deduct it, and then there is no consequences for anybody. So there's going to be consequences because it won't be allowed for the company, and then for you, they will still tax you. You will still pay the tax on it if they find it out from wherever you hide it in the books, right? So that's it. So, but if you structure it properly, if you have a proper structure and you have employment contract that covers you, then of course that cost can be deducted, and then whatever net profit is left is what is subject to tax. So that means that if you make a loss at the end of the year, then you are not paying any tax, right? That is after tax adjustment has been done. So the tax law also still provides make certain provisions around what is deductible, what is exempt, what is not deductible. There's a whole section in the tax law that talks about that, that spells out specific expenses, specific incomes that should not be deducted for expenses, and for income that cannot be subject to tax, be exempted from tax. So after all those adjustments is when you arrive at your tax that is due, right? So after all those adjustments, even if you're in loss position, accounting loss position, there are instances where you can actually be in a taxable profit position, right? If, for instance, you have huge exchange loss or you have depreciation that is enormous, by the time you do adjustments and you add back those costs, you can bounce back to being a profit, a taxable profit position. And then whatever taxable profit you have is going to be subject to tax. So, but if you have a tax loss position, then there will be no tax for you as a business. All right. So that's the process of computing tax due for company. So so, so there are also other considerations that that you consider. For instance, if you have withholding tax credit notes. So withholding tax credit note is the withholding tax that your customers deducted from your invoice before paying you. So if you have those credit notes, you can actually bring them forward and claim them against your tax due, right? So, but the rule is that those credits it must actually relate to that year that you are claiming it for or the previous years. So, meaning you cannot use credit notes of 2025 to offset 2024 income tax liability. So, you can only use 2024 income tax liability to offset 2024. Sorry, you can only use 2024 between tax credit notes to offset 2024 income tax liability, and then you can also use credit notes that are older than 2024, say 2023, 2022, 2021, 2020. You can use all of that also to offset 2024 income tax liability. Okay, I hope that is clear enough. All right. So yeah. So thank you, Moshood. Thank you, Moshood, for your questions. Okay. So back to the EDI. So, so of course, there are conversations around the capital investment requirements. So, people are already discussing that this the investment requirement is actually huge, is enormous, and a lot of investors will be cut out of this scheme if these rates are applied religiously. So, there are conversations around that, and that will be made public in no due time. All right. So under the EDI, you still get to pay tax. So that's a stark difference from what we had before under the PSI. Under the PSI, it's a full company's income tax exemption. So but now under the EDI, you still pay tax. You pay your company's income tax. You pay your development levy. The only benefit you get under this is that you get 5% of your investment, of your capital investment, as a tax credit. So if, for instance, you have invested 100 billion in constructing an asset, then 5% of 100 billion, which is 5 billion, is what you claim as tax credit against your company's income tax during that 5 years period. All right, that is what that's a stark difference from what we had before, where you can actually get full exemption from company's income tax and education tax. All right, so and again, okay, so we're supposed to run this section. It's supposed to be a 1 hour section actually. So, but I think we can stretch it more. We can do 15 minutes. We just cover this and then we call it a day today. All right. So, so you can actually so under this new position, your tax losses will be utilized during the tax holiday period. So because now you're CIT, you are paying tax, so it means whatever tax loss you have, you can also offset it during the tax holiday period. But previously, your losses can be carried forward into perpetuity. Previously, so you don't claim any loss during pioneer period. Then post pioneer, you can now claim your losses going forward into perpetuity. And then withholding tax under the old regime, there was no withholding tax on profits. So, but now withholding tax on revenue. Now withholding tax will apply on your revenue as a PSI. So I think I will stop here. I want to thank everyone that has joined today. So this is a maiden session. Actually, our first edition of the weekly live series. And because it's the first edition, we did not invite any guests at this for this session. So, but the next week promises to be more interesting, more interactive. We are going to bring in a guest, an expert, a tax expert, someone that has been doing tax for a long time. She's going to join me on this session, and it's going to be a question and answer session. So we would open the house. People would ask their questions freely, and then we're able to interact. So the real practical issues, things happening on field, the things you find happening on field in your own company, in your own practice, or to your clients, you can actually bring them up and would have technical conversations around those issues. And of course, we won't leave the non-accountants amongst us behind, the business owners, because they are also supposed to benefit from this. They're actually the target for this, business owners. So we want to make life easier for them so they can learn from other people running businesses, other people applying these principles real time, real life. So that is this will be the end of the session today. I want to thank every one of you that have stayed with us this far, I really appreciate spending your Saturday with us. I know it's not a small gift. Actually, it's a lot of ask for me to actually keep you guys here up until for 1 hour of your day on a Saturday, and you have actually stayed with us, you've engaged with us, and you've also contributed to the session. We thank you very much. We are very appreciative, and we look forward to you joining us again next week. Next week promises to be more interesting, more interactive, and next week we are going to have a guest with us in the house to also share perspective with us on the changes and the impact of the changes. So thank you very much, everyone. Thank you for all those that have dropped comments today. Thank you. We appreciate your comments. We appreciate your suggestions. We appreciate joining us today. We appreciate liking the stream and for sharing and inviting others to join. So thank you very much. Do enjoy the rest of your weekend, and please send me well to your family members, your friends, and all well wishers around you. Do enjoy the rest of the day and your weekend. Yeah, bye.